Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. This is our weekly 2 cent segment. And I'm here with Chris Bates from the Flint Group. G'day, Chris. How's things?
Things are going well here, Pete. It's flying through winter here and off to Newcastle this weekend to see my mum up there. And but nothing too exciting on the agenda here. You've got a bit more going on over the other side of the world. What's happening over there?
We're actually pretty keen on Newcastle as a location at the moment. Spent quite a bit of time there myself last year around Central Coast and Newcastle. There's so much going on in the local economy. We're buying a bit of property around there, commercial and resi, actually. I think it's just a booming economy. What have we been up to? I went to Spurs this week. First time visiting the Tottenham Hotspur new stadium. I think it was £1 billion stadium. It's so good. It's just it's absolute state of the art. I think it's like the world's third best stadium or something after Real Madrid and maybe one other. But it's the kids were breathless with excitement. Unfortunately, lost 3-2 to Bayern Munich, but it was a bit of a friendly game, I suppose. Harry Kane homecoming and full house, of course, 63,000 or whatever it was. So just spending a bit of time around Tottenham is pretty interesting. Always good to get down there and see a few familiar faces. So exciting times here. Not much else really. Work's just ticking along.
Yeah, I mean, it's been a big week in news, I guess. I mean, a lot of excitement post. I think we spoke about it last week around the change in interest rates. And I mean, it's still very early for us, but I could absolutely say that our, inquiries increased. We've actually had a lot of existing clients come back to us who, are in a strong position and they're wanting to transact before rates start to get cut. And so that's always a good litmus test for us when we see our existing clients, come out of the woodwork and we haven't heard from them for a while and they're wanting to take action. And so I'd absolutely say that media sort of story, that confidence around where inflation's going has started to flow through. And a lot of people are sort of wanting to take action post that. I mean, is that something you've noticed as well, Pete? I mean, what are you seeing on the ground in Brisbane as well?
I think, we've been absolutely battered with news over the past day or two. I think most sort of relevant for Australia, Reserve Bank of New Zealand cutting interest rates. It wasn't really nailed on, but I think a lot of these central banks now starting to see unemployment rise and, cutting rates. And they're pretty dovish sort of a statement. So there's more rate cuts to come in New Zealand. Back in my old haunts in the UK, the core and services inflation lower than expected. So the Bank of England's going to be cutting. US inflation was lower than expected. So the Fed's going to be cutting. So I think, as you said, a lot of this is feeding into a general expectation that Australia will be following soon. Now, just to timestamp this, we're recording this on the morning of the labour force figures. So by the time this goes to air, the unemployment figures will be out. But certainly what we're getting from clients, what we've been hearing over the past 18 months, a lot of people are saying, well, hang on, when are these holding costs going to come down a bit, especially the investors? I think, interest rates went from very low levels, maybe 2% on the fixed rate mortgages, and now people are paying 6 or 6.5%. And if you think about a lot of resi properties on yields of 4% or 4.5% gross, and then you take off the other bits and pieces like the property management, the insurance. There's a lot of properties that are really just have a big negative carry, and that's starting to hurt. I think a lot of investors have been compensated by capital growth, but they're getting a bit sick of the cash flow. So, I think a lot of people are now sort of saying, well, okay, this is great, but when are rates going to be cut? Now, at the time of recording, there's an interest rate cut fully priced in for Australia by December, but obviously things could change, could get pushed out to next year. There's definitely, for new buyers, there's some talk of getting in before rates get cut. But I'd say just as equally, there's enough people thinking about, well, how long are these negative holding costs going to be with us because it's starting to hurt a lot of households. And you're just starting to see that in things like so CBA had their results out this week, and 90-day arrears just starting to tick up to above average now. And obviously there's some households feeling the pinch.
Yeah, absolutely. That'll be the case. I mean, the longer rates are higher, the more you exhaust all your buffers. You sell your shares, you sell other assets, you try to change your work, you maybe work more hours, you make cutbacks at your family home. So I think people are doing everything they can to stay in their homes. Hence why we haven't seen listings shoot through the roof like everyone was anticipating when the rates went up. It takes a long time for these things to work through. I mean, on a positive for these people, though, is that the fixed rates are starting to come down. We've started to see a few banks reduce their fixed rates. I mean, we're starting to get in the mid fives or high fives. And who's to say that, we start to see some really good fixed rates come out over the next, 6 months where they're well under the variable rate. I mean, whether you should lock in or not, it's a different story, but it's going to give households a bit more confidence on where rates are going. I mean, we can see the 3-year bond yields come down a lot. So I do think people are, but you still have to pay your mortgage. That's the even if it's going to get cheaper in the coming years, it doesn't mean you don't have to pay it today. And I think there is going to be a bit of pressure on some households who just haven't got a way to get through. If you're in that position, though, don't just rush to sell. I do think you need to maybe even speak to the bank and just see what potentially you can do and exhaust all your other options, because getting out sometimes not the right decision. You then have to buy back in. You've got selling costs. The market could easily surprise you to the upside. And so, if you are struggling, exhaust all your options before just throwing your property on the market would be my bet. I mean, it does give people more confidence when they see around the world cutting rates. Pete, I mean, the New Zealand cut kind of surprised people. Was that your take?
Oh, look, I think market pricing was 72% for a cut, but there's a lot of economists saying, well, maybe not yet. But I think there's one thing that gets central banks motivated to start cutting is rising unemployment. And New Zealand unemployment was 4.6%, and it's going up pretty sharply. They only report it quarterly over there for whatever reason. But I think it was, looking at what's coming, there's some pain in the economy there. And so it looks like more cuts to come. You made a good point on the fixed rates there. It was only, if you went back to the first week of July, Australia's 3-year government bond yield was 4.2% or pretty close to 4.2. Now it's 3.5%. That's a massive shift in only 6 weeks. And as you said, that's a key funding benchmark for Aussie banks. And it starts to feed through into lower fixed rates. And I guess that's the canary in the coal mine for interest rate cuts ahead, because there's lower fixed rates below the variable rate, and people start looking at that. Yep. So, I think it's we'll have to see what happens with the unemployment figures here, because I saw Roy Morgan had their sort of shadow unemployment rate, and that was above 10%, highest in a year. So I don't know whether the ABS figures will start heading in that way. We'll have to see later this morning what the latest news is. But I think if things are holding together in the Aussie economy, then interest rates stay on hold. But if things start deteriorating, then cuts will come into the equation towards the end of the year.
Should we crack into the 3 stories this week, Pete?
Yeah, well, the first one of the 3, Reserve Bank taking a bit of a potshot at commentators. So it was a speech from Andrew Hauser at the RBA, fellow Brit, I think. I didn't listen to the speech live, but just talking about, I think, some of the dangers of overconfidence. So the Deputy Governor, Andrew Hauser, basically warned on overconfidence on the outlook for interest rates. I think this was a speech in Brizzy, actually. And he said that anyone claiming interest rate prescriptions are obvious are false prophets. Prophets as in the biblical sense, not in terms of the CBA massive profit sense. And he sort of pointed out in the speech, eye-catching language sells newspapers, secures clients, and draws crowds to the soapbox. But I think, what was the old quote? Predictions are hard to make, especially about the future. The reality is, if you think back to 2006 or 2019, nobody had any idea how things were going to play out. So why would it be any different today? So I think just reading between the lines, Hauser was talking about a less activist approach to interest rates. So I think to me that sort of hints at interest rates staying on hold for the next 5 or 6 months while we see what happens. There's obviously risks to the upside, risks to the downside. But yeah, I mean, this is the way online media has gone, isn't it? Articles are going to get more people clicking if they are more clickbaity. It's even true for these podcasts, right? The more clickbaity the title, the more people check it out. So I think that's the way things are inevitably going to be. But maybe a bias towards inaction now for the RBA.
Yeah, I mean, this is sort of the forward guidance, isn't it? When rates were really low, we're going to keep the rates really low, and that got people to leverage up. Now the sort of rates are high. They're going to say, well, we're going to keep the rates high because they really want to put the inflation genie back in the bottle. But I don't know. I think there is some really positive signs in terms of inflation dropping. I mean, yes, they definitely want to kill it, right? But yeah, I mean, is that sort of your take on this article as well? They're just trying to calm down people's overconfidence that rate cuts are coming, and and hopefully that doesn't delay them being able to make rate cuts because all of a sudden the numbers start bouncing. Is that sort of what they're trying to do here?
I think the communication, there's been a bit of jawboning over the last few weeks, I suppose. So sort of cautioning people not to expect interest rate cuts because the last thing we want. I mean, it's quite interesting when you look at global inflation. If you look at most of the other sort of comparable countries, they've got inflation down to 2 to 3% or just a little bit above. And we're just a bit further behind on that journey because we stayed locked down for longer. So inflation peaked 6 months later than Canada, New Zealand, the US. So we're sort of 6 months behind those countries and 2 months behind the UK and the Eurozone. So it kind of makes sense. It would take us longer to get back down to 2 to 3%. I think, but probably over the next 3 or 4 months because of the base effects, that will help us get down there. The last thing the Reserve Bank wants now is consumption to kick up again, people getting excited, borrowing big numbers in the housing market, because that's actually going to delay the journey back to target inflation. So they're talking tough. But yeah, I think the key driver for people who are actually interested in what's going to happen is probably the unemployment rate. I think if it stays somewhere near 4%, well, forget it. Like, we'll keep interest rates on hold. But if it starts deteriorating towards 4.5% and 5%, well, that's a whole different story, and then we'll get cuts.
What's your take, Pete? If we end up cutting later than, and our bank rate, central bank rate is higher than other countries around the world, so we stay much higher, even though we've been lower than what they've been around the world. You've seen the 5s in the US and UK, etc. If they start to get well under our rate, do you think that's going to affect us at all? What will be some of the consequences, you think, of a higher RBA rate here when the rest of the world's cutting strongly?
Yeah, I mean, I suppose there's always potential implications for the currency in particular, and whether that makes a difference. But I mean, I think it's fair to say monetary policy here in Australia is influenced by what happens elsewhere in the world, but it doesn't have to follow in lockstep. And in fact, we've seen this on the way up and on the way down previously. We don't have to follow exactly in the same footsteps. But I do think in general, though, if you're getting cuts in the US from September, we're already seeing cuts for New Zealand. The UK is going to be following on the way down. Canada. Well, if all those countries are sort of easing and the inflation trends, I actually put a graph together of this on my blog just to show how correlated inflation seems to have been over the past 4 or 5 years in all those countries. Well, if they're all cutting interest rates, it probably makes sense that we're going to be heading at least directionally in a similar manner, even if the timing's behind. So yeah, we'll see what happens. I don't think being a few months out of lockstep is a big deal either way. But yeah, I think it's pretty interesting. I think in terms of what it means for us as individuals, well, I mean, cautioning about the dangers of overconfidence is always a good one. I think it's always good as well to have a kind of general investment thesis or set of ideas that is based around you being approximately right and not precisely wrong. I think when you're too reliant on market timing or certain outcomes going exactly right, well, that's pretty difficult because all of the forecasts show that you just can't predict this stuff. And the Reserve Bank, I mean, it cops a lot of heat when it gets forecasts wrong. But in all fairness, they release the fan charts with a 70% confidence interval and a 90% confidence interval. But I think it was Glenn Stevens said previously, there's no point in just releasing those because people would just draw a line through the middle and infer their forecasts anyway. And the reality is, like, it's been a very, very unpredictable 4 or 5 years. And I think anyone who is being honest would say they didn't actually predict it either.
Yeah, and I think when you look at the RBA's predictions over the years, you'd have to say they were overconfident and under and at different points in there. You look back at their, I think their quarterly reports. I did a thing on the elephant a couple of years ago, and they've been awful at predicting where the world's going. So it's always a bit interesting when they're saying don't be overconfident when they've been that in the past. So, I mean, let's go to story number 2, Pete. I mean, I think this is the interesting thing when I was reading some CBA articles yesterday where, what was the makeup of inflation and where's it coming from? And not everything's equal, right? Whether it's, insurance or bank fees or housing costs or tobacco and, they all have different weightings, right? And so if something goes up more than others, it does matter. But housing's been probably the biggest contributor, right? Everything from rental costs to the cost of construction. So do you think there's some good news here, Pete, with inflation? Because if that's been the biggest contributor and it's reversing, what's your take on rent prices?
It's actually, you're right. So one of the reasons that the US inflation figures are being looked at as less threatening by markets now is because shelter inflation, it's been massive, but there's definitely a lag, I think, in terms of the official inflation figures. So what you see in real time in housing markets is people advertising properties for rent, and but it takes a long time for all of those leases to be taken up and for it to flow through to actual inflation, if that makes any sense. So I think similarly for Australia, I think CoreLogic reported a 0.1% increase in rents in July. SQM recorded a decline in asking rents. I think they were down about 1%. So, I mean, that's definitely, well, these are the weakest sort of rent figures we've seen in about 4 years. Now, that might take some time to flow through to the official inflation figures. I think we've also seen construction cost inflation, which CoreLogic sort of measures. That's the lowest in 22 years. It's been obviously very, very hot in recent years. So I suppose the one question could be, is this just a seasonality thing? And is it just a quiet time of year? And could rent start taking off later in the year? It feels to me like what's happening is that tenants are just jockeying for better deals. The rental market is much more flexible than people think it is. So although we haven't really tackled the housing shortage by building more dwellings, people are just, household sizes are starting to sort of pick up again. People are staying home for longer. They're buddying up. And it's just an affordability thing. I think rents go probably up 40% in recent years since the start of the pandemic. And people are starting to shop around a bit. So vacancy rates are still pretty low, 1.3%. But I think actually for inflation in rents, well, it's starting to roll over now.
Yeah, I think that's the key point here, right, Pete? I think that if there's less pressure on rents going up, that's a good thing for inflation. But ultimately, the vacancy rate still being very, very low is always going to create competition in rental markets, particularly if demand starts to increase. Like there's the seasonality parts of this as well. And so I'd have to say we've got to watch this really carefully because, yeah, I mean, there might just be slowing down right now as people make adjustments, but maybe there is still a bit of, upside in rents to come, right? If a lot of international students come or just naturally, we see a bit of spike in rental demand over summer, et cetera. But it's good news because, this is a big contributor to inflation is the rental costs. And I was saying the building side as well, Pete, while builders aren't probably reducing their prices and a lot of capacity is going out of the building market. So that's allowing them to keep their prices higher, if anything. Do you think that that's a good sign as well, Pete? We're seeing a bit of a rollover in terms of the cost to build and we probably won't see too much inflation there as well.
Yeah, I mean, generally, the history shows that construction costs are pretty sticky. So they go up, but they don't really come down. They flatten off for various periods, but for certain reasons, partly because of wages, that's a big part of it. Heavily unionized sector of the workforce, of course, in construction. So, I do think they're leveling off. I think it's just part of the issue with supply chains around the world. I suppose the one thing that is just a question mark for me is how much of this is just a seasonality thing? Because this is part of my thinking, right? Is that if you went back through the pandemic, we had, just before the pandemic, we had 2.4 million on temporary visas, people in Australia on temporary entrance visa holders. Then obviously during the pandemic, loads of people weren't here, working holiday makers, students, and we lost about 800,000. And then it came rocketing back. And that's essentially what has driven the rental issue, is that the number of people looking for a rental changed much more quickly than, of course, the supply could change. And then obviously that's driven rents up 40%. I just think when you look back a decade ago, we had, just looking at my numbers here, if we went back to 2014, we had about 1.8 million temporary visas. Now it's about 2.8, so an extra million people, but it's very, very seasonal. There's times of year when we get a lot of tourists, and there's obviously the international student term times. I just wonder, like at the moment, obviously the numbers are sort of talking about a quieter time of year, but if we get towards later in the year when we've got students around, plus the summer months, you get a lot more people sort of visiting, tourism and all of that stuff. Is it just going to squeeze that vacancy rate lower again and we end up with the rental crisis having a second wind, or is the market actually sorting itself out? So I don't really know is the answer. We'll have to wait and see.
Yeah, I think it would just definitely, I wouldn't put that one back in the bag if it was me. I think we could get surprised, the seasonality there. And I think we could even be surprised with price growth over this spring period. If we see that buyers do start to enter with more confidence on very, very low listings, there's always that supply and listings lag. I mean, I've been looking at number of properties over the last couple of weeks. It's still very dire. You think a lot of agents have been talking about front-running listings. Let's get listings earlier in the campaign just in case more supply comes on later in the campaign. I've had a number of agents say that online, but I look online and not many new listings are coming on. So I think they've also been just talking it up. I think that it would be a very dire amount of new properties coming on the market, particularly quality assets and housing markets over the next 3 or 4 months. And I think you're easily going to see more demand enter than more listings. And listings are more likely to come on next year when, vendors are much more confident on where rates are going. And then they decide, okay, well, now it's actually a good time to sell so I can upgrade. Is that your take, Pete, over the next few months, that we're going to be a little bit disappointed with what comes on the market, or are you a bit more optimistic than me?
It seems to be a bit slow, to be honest. I think there's some investors have been selling up, but then I think part of that rental crisis story is that there's more investors coming in as well. So it's kind of absorbing the listing. So, yeah, I mean, traditionally we've said the spring selling season is when you start to see listings pick up sharply. But at the moment, total advertised listings in Western Australia, South Australia, Queensland, they're all actually lower than they were this time last year. And there's limited supply, and that's really sort of underpinning those markets. If you look at Tasmania and Victoria, those are the two markets where listings are sort of accumulating. And of course, that is actually, as you said, reflected in lower prices in those markets. So I think, Victoria, we might talk about this in the next section. A lot of people asking about all the negative headlines on Victoria, states going bankrupt, economy slowing. But yeah, I think with property markets, you really need to sort of take a 10-year view. And often you'll find that the worst performers in one period are then the best performers in the next period. The last will be first and the first will be last sort of thing.
Yeah, let's go to story number 3, Pete.
Yeah, so third story to wrap up this week, wages growth has peaked. So wages growth it always seems to disappoint on these ABS figures. It never seems to be a good set of numbers, but they're weaker than expected in the June quarter, 0.8% over the quarter and 4.05% over the year, which basically rounds to 4.1. But it was especially soft in the private sector. So yeah, for sure, if you work in the public sector, there was a sort of a better number. But private sector, 0.7. I think this has been one of the criticisms of the government, actually, is a lot of the jobs growth has been public sector, NDIS, and sort of some of the less productive roles in the economy, but the private sector is struggling. Over the year, Tasmania had the highest wages growth at 5.1%. Victoria was the slowest at 3.3%, and rolling over quite a lot. I think I was looking at the government's job vacancies figures this week, and Victoria's down 7% in July and 32% over the year. So obviously, sort of some of those tax moves and some of the other stuff that's going on there is not being good for employment or business at the moment. It's going to have the highest unemployment rate as well in Victoria. So, yeah, I mean, look, this is good news for the RBA. Wages growth peaked and rolling over. That's certainly disinflationary. I think Jim Chalmers, the Treasurer, is trying to talk the numbers up and say, 4.1%. But the reality is, if you look at the last 6 months, wages growth is lower really than the rate of core inflation. And that's disinflationary. It's sort of, it takes pressure off consumer spending. So, yeah, good for the RBA. But, what do you think about Victoria? I get a lot of people asking about it. Market's been struggling in the housing sector. Quite a sort of lot of negative articles around about the economy and what's going on down there with the state government. What do you think?
Oh, I think it just needs a good summer of sport down there and it get its mojo back and people to get back to the city. I mean, Melbourne's always going to be one of the best cities in the world, let alone Australia. And I think it just literally has to get the confidence back. I think it's been shaken the most after the last 4 or 5 years down there with everything that's happening, COVID and Dan Andrews and all the lockdowns down there. And I do think it's just a little bit of a laggard compared to, the return to work that we've seen in Sydney and Brisbane particularly, right? I think that I was just reading an article only this morning where they've got the strongest, probably the commercial market. Vacancy rates are really quite tight and people are coming back and there's a bit of a vibe in the city. And so I think Melbourne's going to get it back. You've got to be pretty brave to bet against Melbourne and that it's never going to become back as where someone wants to live. It's just got so much inherited wealth and culture and communities from all over the world. So it's very good for immigration, lots of employment hubs and in lots of different sectors. And so the tourism down there, the sport. So I don't know. I think people can be talking down on Melbourne, but ultimately, if you believe that hybrid work is the way that we're going to go and not work from home 5 days, and we're actually going to probably lean more towards the office versus at home rather than, 4 or 5 at home, maybe 3 or 4 in the office, then I think Melbourne gets its mojo back. People will want to live close to the capital, to the city, because they want to be able to get to work, get home in a reasonable time frame. In there, you've got scarcity of housing, and you've also got a massive underbuilding now. It used to have an oversupply problem and too many investors down there, so you had rents were quite cheap, and so a lot of people weren't forced to buy because they could rent. I think that's going to flip. I think people are going to go, hang on a sec, I do want to buy. There's not many investors going down there, so rent's going to get harder. And I would say I'd bet pretty strongly on the inner ring housing market there. I think it's when you look at where do you want to put your money right now compared to other markets where they've gone up a lot, I'd probably bet on the Melbourne market, even though there's land tax issues compared to other states. And so I'm a bit more passionate about Melbourne. I think there's a lot going for it down there. I just think it's also winter and everyone's depressed in Melbourne in winter.
Yeah, Brisbane Lions flag this year or premiership would be good if they can make another final. But I think it's I think the thing that will turn things around is relative affordability. I think if you look at a house in suburban Adelaide or Brisbane now, well, it's no cheaper than Melbourne. And Melbourne's a big city where a lot of the big employers are based. And I think I can't remember if we touched on this last week, but when I saw that Mirvac update to the ASX, they reported a statutory loss because office values were down. But the thing that just stood straight out was that their apartment pre-sales have just dropped off a cliff. It's just there's more profitable things for developers to be doing at the moment than building units, and it's really restricting supply. There's all this talk in the media, Housing Industry Association saying policy resets required if we're going to meet all these targets, and the government's making a lot of noises. But at the end of the day, it's too risky, and there's not enough profit in building units at the moment. And if you look at where the supply comes from in Sydney in particular, and also Melbourne, it's attached dwellings, it's units, apartments, townhouses, duplexes, and they're just not being built. So, yeah, I think in the short term, rental market's cooling a bit, but I think if you're taking a longer term view, there's just an underbuild, an undersupply over the next few years, and that relative affordability, I guess, will turn things round once interest rates start falling. So, pretty interesting week. So much going on at the moment in terms of global news. So it's always pretty interesting to track it all.
Yeah, I do think the interesting is going to be what's the consequences of our state governments having a lot of debt. Does that mean that our infrastructure spending does have to? I mean, what we've seen in recent years with metros and trains and trams in Sydney and roads and freeways has been a huge catch up, right? And there's been a huge amount of spending. And Melbourne and Victoria have got some huge plans with outer city sort of rail. They've got a huge east-west sort of link going on at the moment, and huge upgrades. The north-east link, I should say. So, I mean, what's your take, Pete? If the state governments are in a lot of debt and they've leveraged up, and are we going to see a real reduction in infrastructure spending? I mean, the Queensland government are obviously doing a lot because they're going to have the Olympics up there, which is pretty exciting. After you've just seen the Olympics, you sort of forget what it's actually going to mean for the city and putting it on the global map. And so, watching Paris just over the last few weeks, it sort of made me really think, maybe this is a bit bigger than I thought, the Brisbane Olympics, in terms of giving it some better global attention. But what's your sort of take on the government having a lot of debt, and are we going to see infrastructure spending really dry up as a percentage? And when that does happen, if we grow our populations at the same time, we start to get those same cracks in the way that we move around our city, and we see gaps where we should have spent more money. What do you think?
Yeah, I mean, everything that's old is new again. I think if you went back, this is before my time in Australia, but it was the Jeff Kennett years in Victoria, and there was billions of dollars of debt in Victoria. People would say, well, how are they going to come out of this? And there was cuts on spending for state schools, and there was loads of issues with some of the big transport projects. So I think the way that Victoria gets out of this, I mean, it wasn't so long ago that New South Wales had similar issues, very reliant on the stamp duty take there, but they really tackled government debt in New South Wales with asset sales. There were some big sales of public assets, and then the world keeps turning. I mean, there's different ways out of it. There's more taxes. There's a federal potential bailout, or maybe asset sales. But things will come around again, I'm sure. Obviously, no Commonwealth Games in Victoria, but let's not go down that route. But I think, look, the resources states are generally in a better position than Victoria is at the moment from a state debt perspective. WA, gosh, I went to Optus Stadium a little while back, and it's fully paid off. It's an amazing asset there, right in the heart of Perth, and different story in other parts of the country. I think for Queensland, I mean, the challenge now, they've got to make some decisions. There's been a lot of dithering, but now the clock's ticking down to the Olympics in Brisbane, and they actually need to start making some harder decisions about where the infrastructure is going to be built, which stadiums are going to be upgraded and which aren't. I'm sure it'll all be delivered, but it's got last minute sort of rush written all over it, just the way things seem to go in Queensland.
And what's your take, Pete, just to wrap us up today on this? We've had the inflation high for a few years now. There's a lot of people who have not been able to hold on, right? They absolutely have sold out of housing markets and investment properties. And you've seen that just in terms of what properties are on the market, and the ex-rentals is quite a huge portion compared to old standards, particularly in certain pockets as well where you see more listings. So a lot of investors haven't been able to hold on, a lot of owner-occupiers as well. They're the ones who haven't been able to sit in, ride out this wave. What's your sort of take on the benefits of inflation once you get through that period, if you've been able to hold on to assets?
Yeah, I mean, the general idea, I suppose, as a property owner, is that inflation benefits you a couple of ways. Firstly, the price of new housing goes up, and as a function of that, established housing is sort of underpinned. But the other thing is your debt effectively gets inflated away. I suppose I was talking on a webinar the other day. I think it was on the Australian Property Podcast. Actually, we did a little episode on what inflation means for property. In fact, check that one out. It was a bit of a monologue, but yeah, I guess the general idea is, if you go through your career, you get more experience, you get pay rises, wages generally go up anyway. If you're getting 4% per annum, that 100K wage that you've got today in 25 years, it's going to be worth about double that. And then obviously any debt that you've got on the property, partly you pay it down, but also it's effectively inflated away. It feels like a much smaller balance as your pay goes up. So yeah, I think, construction costs must be up 40-50% over the past 4 or 5 years. So obviously if you've been able to stay in the market, and don't forget 2019, people were talking about housing bubbles. There was all these sort of podcasts and media talk about housing bubbles. Well, that's been and gone because the cost of new housing is up by 50% since then. And you can see in Brisbane, in Perth, in Adelaide, those numbers in 2019 now look cheap. So I suppose if you've been able to stay in, the cost of holding property has been painful, but you've been compensated by capital growth in a lot of cases as well.
Yeah, and I think that's the key point, right, is if you are able to get the cash flow through that period, and on paper you might go, oh, my cash flow has been really hit and it's been really painful for that period, and you had cutbacks and maybe you haven't lived the life that you wanted to live over that period because you had to give it to the bank rather than spending it on holidays. You've been able to hold those assets. Those assets get repriced. That debt's nowhere near as much. On the other side, wages have gone up, and the cost of new builds has gone up as well. And so I think in a few years' time, people are going to probably see the benefits of that, and they go, hang on a sec, that was a painful period, but I actually got the benefits for it. And my debt, my wages have gone up, and my property price has gone up as well. Is that your sort of take?
Yeah, I was looking at a graph only about an hour ago about the value of the dollar over 200 years. Well, it goes from $1 to basically zero. It's like 0.0. And that's the thing, right? Is that you own hard assets because of inflation. And UK has had 11% inflation at the peak. US had 9%. We're a bit lower in Australia, but you don't need too long a period of inflation like that. And you suddenly look back and wonder how prices were so cheap a decade ago. But that's the way inflation goes. It's cumulative. So it's been a rough ride, I guess, over the past 4 or 5 years. But I suppose if you think about how things might have gone with a more severe pandemic, relatively speaking, inflation coming back under control, interest rates set to fall, it could have been a lot worse, I suppose.
Yeah, that's absolutely the case, right? If there's a lot of doomsday over the last couple of years, and they could have been founded and that could have actually played out. But at this stage, it looks like the inflation genie's back in the bottle. But let's not call the party happening right now. So good to chat this week, Pete, and look forward to, and happy Sunday to everyone listening.
Cheers, Chris, and do check out the Rask Community Forum. Plenty of activity there this week if you're interested in chatting, not just about property. There's sections on everything for ETFs and business and everything else. So come and join the party over there as well. Have a great weekend, everyone, and chat soon. Cheers.
Chat soon.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.